In 1815, after Napoleon's final defeat at Waterloo, Nathan Rothschild famously said, "I care not what puppet is placed upon the throne of England to rule the empire on which the sun never sets. The man who controls the British money supply controls the British Empire, and I control the British money supply." And while historians debate whether he actually spoke those exact words, what's undeniable is that by the end of the Napoleonic Wars, the Rothschild banking family had become the primary creditor to multiple European governments and had established a financial network so powerful that kings and prime ministers sought their approval before major policy decisions. This pattern repeats throughout history with different actors, but always the same fundamental dynamic. Sovereign debt is never just an economic relationship. It's a power relationship where those who control credit effectively control national policy. The story begins in medieval Italy, where city-states pioneered government bonds in the 13th century. Before this, kings financed wars through taxation or borrowing from merchants, and then defalling Edward III's defallen Florentine bankers in 1345 destroyed some of Europe's largest banking houses. The Italian innovation was bonds citizens could buy and sell in secondary markets, creating creditors with vested interest in the government's fiscal health. The Dutch perfected this system, maintaining Europe's lowest borrowing costs because investors trusted them to honor debts, allowing a small nation to dominate global trade. The lesson was clear: the ability to borrow at low rates was a force multiplier, but creditors gained policy influence because governments needed to maintain their confidence. The British Empire perfected this system after 1688. The Bank of England was created in 1694 to help the government borrow for wars, given a monopoly on banknotes in exchange for lending at favorable rates. Over the next century, as Britain fought repeated wars, the national debt grew from £1 million to over £800 million by 1815. This debt was increasingly owed to international bankers, particularly the Rothschilds, who established branches across Europe, creating the first truly international banking network. They made fortunes lending to governments during the Napoleonic Wars, and Nathan Rothschild became so influential he learned of Waterloo's outcome before the British government. More important than any single trade was the structural power. They could raise money, others could not, move gold and credit across borders, and possessed information networks better than most governments. This made them indispensable, and indispensability translates to power. When Latin American countries sought independence in the 1820s, they turned to London bankers. The debt wasn't just financing, it was binding nations to a financial system controlled by interconnected banking houses. This intensified with colonialism as European bankers lent to non-European governments on terms amounting to financial colonization. Egypt borrowed heavily in the 1860s-70s for infrastructure, including the Suez Canal. When Egypt couldn't service these debts, European creditors pressured their governments to intervene, leading to British occupation in 1882. Egypt remained under British control until the 1950s, its policies dictated by the need to pay European creditors. Similar patterns played out globally. Loans came with conditions giving creditors influence over tax policy, trade, and resources. This was the hidden power. Debt allowed creditors to reshape entire economies, to prioritize debt service over development, extract wealth through interest payments exceeding original loans, and justify military intervention when governments threatened default. After World War II, sovereign debt architecture was restructured around the IMF and World Bank. Created at Bretton Woods in 1944, their governance gave the US and Western Europe dominant voting power, and loan conditions effectively allowed them to dictate economic policy to borrowing nations. When countries faced debt crises and turned to the IMF, they required structural adjustment programs, cutting spending, privatizing state enterprises, removing trade barriers, implementing austerity that devastated populations while ensuring foreign creditors got paid. The 1980s Latin American debt crisis illustrated this. Countries had borrowed heavily when rates were low, but when the Federal Reserve raised rates dramatically, the debt became unpayable. Rather than default, they turned to the IMF, which provided loans conditional on austerity that crushed living standards while ensuring American and European banks received interest payments. Latin Americans still call the 1980s the lost decade, but here's the crucial turn. Today, the real power lies not with governments or traditional banks, but with a small number of institutional investors, pension funds, insurance companies, and especially asset management firms like BlackRock, Vanguard, and State Street controlling tens of trillions of dollars and serving as primary creditors to governments worldwide. BlackRock alone manages over $10 trillion, more than any country's GDP except the US and China, and is the largest holder of US Treasury bonds outside the Federal Reserve and foreign governments. When governments issue debt, these firms are the primary buyers. This has created a situation where perhaps a few dozen institutions have effective veto power over government policies in debtor nations. The global bond market is worth roughly $130 trillion, and this ownership concentration means that when you're the largest creditor to a government, that government needs to care what you think, because if you lose confidence and sell their bonds, their borrowing costs rise and their fiscal position deteriorates. The mechanism through which this power operates is subtle. Credit ratings agencies, primarily Moody's, S&P, and Fitch, are seen ratings determining how much interest governments must pay to borrow. When an agency downgrades a country's debt, it triggers automatic selling by institutional investors required to hold only investment-grade securities, creating a self-fulfilling crisis. Governments are therefore intensely focused on maintaining good ratings, which means implementing policies, ratings, agencies, approve youth fiscal austerity, structural reforms, privatization, debt service, prioritization. Critics note ratings agencies failed spectacularly to predict the 2008 crisis, giving high ratings to worthless mortgage-backed securities, yet maintained their oligopoly. The answer: they serve large creditor interests, and as long as they do that, their occasional failures don't threaten their position. The power dynamic becomes clearer examining how debt crises are resolved. When Greece faced a debt crisis in 2010, the official story was Greece had lived beyond its means and needed austerity. The reality: much of that debt was owed to German and French banks, and the bailout of Greece was really a bailout of those banks. The EU and IMF lent Greece money which Greece immediately used to pay back German and French creditors, while Greek citizens endured depression-level collapse with unemployment exceeding 25%. The debt burden actually increased, making Greece's position worse. But German and French banks were made whole. Similar patterns played out in Argentina, Russia in 1998, Asia in 1997, and various African countries. The consistent element: when crisis hits, solutions protect creditors while costs are borne by detonation citizens through unemployment, reduced services, and economic hardship. Perhaps most shocking is how this operates on wealthy countries, including the United States itself. Even the US is constrained by debt markets when Congress debates fiscal policy. A primary constraint is how bond markets will react. This gives bondholders effective veto power over ambitious spending programs. During the 2008 crisis, the US government bailed out the financial system for trillions to prevent collapse, protecting creditor wealth while homeowners foreclosed and workers lost jobs. The Obama administration prioritized to foam in the runway for banks rather than providing direct relief to homeowners or prosecuting fraud. Recently, debates over student loan forgiveness and social programs are constrained by debt concerns, while spending on bank bailouts and corporate subsidies faces fewer constraints. The pattern reveals which interests the debt system serves. Throughout history, excessive debt burdens have eventually been resolved through default. Inflation, or restructuring jubilee, debt forgiveness in ancient Israel, Roman currency debasement, medieval debt repudiations, post-World War II write-downs. Every empire that has risen and fallen has faced a debt crisis contributing to its decline, and the current system has lasted roughly 80 years since Bretton Woods. The stress fractures are visible. Unsustainable debt levels in virtually every major economy. Growing inequality, driven by debt service, transferring wealth from workers to creditors, political instability from austerity programs, and periodic emerging market crises is the hidden power behind every nation's death. The network of institutional investors, ratings agencies, international financial institutions, and legal architecture protecting creditor rights, above almost all other considerations, has created a system enormously profitable for those at the top and increasingly unsustainable for everyone else. Understanding this power structure clarifies why so many economic problems seem immune to democratic politics. Real decisions are made not by elected governments, but by creditors to whom those governments are indebted, and those creditors have interests often conflicting with ordinary citizen welfare. The debt isn't just money owed, it's power exercised. And until we collectively understand that dynamic, we'll keep being mystified by why governments seem to serve bond markets rather than their own people. If this exploration of financial power structures has illuminated forces you suspected but couldn't quite name, consider following the empire economy for more investigations into how debt and money shape the rise and fall of nations.